Let's begin. I am Marina, the Trader Chick, and as you can see, that is one of my favorite little humans sitting next to me. And I actually have a really fun question for you guys. Who here likes Cirque du Soleil? Do you guys know what Cirque du Soleil is? If not, it is something that everybody needs to at least experience one time in their lives. And it's amazing, right? And the fact that if you even know about it, the reason why I bring this up is it will make sense how this relates to trading. Because one thing that I recognize with the most successful traders is that they live a full life. The ones that are really struggling are the ones that are obsessive in front of the charts. I've been there. I am 100% guilty. I spent 5 years obsessing over the charts until I started to realize that day trading isn't just the charts, it's a whole thing. And so I obviously have a confession. I am an insane Cirque du Soleil fan. And I really wanted to express to you how trading and Cirque du Soleil really relate to one another and how it could actually help you become a much better trader. Because if you think about it, the performers, they are literally ordinary humans that are doing extraordinary things. They are people like me and you, right? They are not any different. But what they did was the steps they've taken to do what they're doing is what makes them different. And we could do all of that. And that's my goal for you today is what it literally takes an ordinary person to become an extraordinary person. It could become extraordinary. It's literally the same as how a successful day trader does that, right? And I break it down to several things. Commitment. Okay, we understand there's not even a doubt in our mind when we go to see a Cirque du Soleil show or even understand what Cirque du Soleil is, that the people that are performing, they have done years of perfecting their mastery, right? It's a given. However, I'm noticing that many people who want to become really good traders or consistent traders, they are not committed enough. They do not put in the time that it's necessary. The other thing with Cirque du Soleil performers is their intense focus, right? They imagine being on a tight wire and starting to, make a phone call or talk to somebody in the room or check a different, or maybe decide while you're on the high wire that you want to be shot out of a cannon. It's ridiculous. Yet day traders do that, right? They have multiple charts. They're on their phone. They're doing different things. Their focus isn't there. Discipline. No matter what, these performers show up every single day. They have a strategy, they have a procedure, and they follow it. A lot of traders who are not doing well, they don't have that discipline. They do not show up every day. If one little thing goes wrong, they completely change their strategy midway, usually during a live trade, right? So there is no discipline, right? And then they're like, oh my God, I have no discipline. But discipline isn't about actually having discipline. It's literally just following your strategy and showing up every day. And trust. Have you guys watched these Cirque du Soleil people, especially the ones that do with partners, or it doesn't even have to be partners, it could be their equipment. First of all, they have complete trust in who they are because they have put in that time. They understand what needs to be done. They have complete trust in their partners, right? They have complete trust in their routine and their strategy, and they have complete trust in their equipment. You cannot, and I get this so much. I get so many people come to me who barely even know how to work a chart, and they are going live trying to enter trades. And oh my God, I just put in a sell when I wanted to buy. You know what? Great, but do this in sim. Why are you doing this live? They don't even have trust in their equipment and they're putting money. I don't know about you guys, but money, it takes time to earn, right? Do I want to just be practicing and with real money to learn a new equipment? Definitely not, right? Confidence. I'll go back to that again and again. They have confidence in themselves. Why? Because they have put in the time. Okay, look here. This is important, guys. This is being in a live trade. This woman is being in a live trade. Now, does she have any doubt that her equipment is going to fail? Does she have a doubt that her bar is going to collapse? No, she's tried it 1,000 times. Does she have any doubt in these guys that are holding her? No. You have to feel that kind of confidence when you are going live. So what do the Cirque du Soleil performers, directors, choreographers, and day traders have in common? Way more than we all think. Look, we all hear that 5% of day traders are successful. So what happens to those 95% that aren't? And I pretty much explained a lot of what they aren't doing, right? So it's what everything I told you, it is not hard to do, because if you guys are here on this presentation, that means you're already showing that you are committed enough. Now it's about that commitment, going every day, that discipline. But it's not just sitting there and looking at the charts, right? It has to be smart. It can't just be hard work, because hard work doesn't really get you anywhere. I remember my father one time gave me a really good anecdote about busy work versus smart work. There was this bear in the jungle, in the forest, and he decided to move one log from one side of the river to the other side. And he took it over to there, and he decided he didn't want it, and he brought it back. Now, then he was like talking to his friends, and he was like, oh my God, I was so busy all day moving logs, but he did nothing. So do you guys want to be doing the busy work and not going far, or do you want to be smart about it, right? It's about all of that. So the real question is, what can we do differently from the 95%? Since I'm not able to do everything and tell you everything, I'm going to focus on that one specific thing that I guarantee you right now will take you to your next level. So we're going to talk about trends. Trends are literally the tightropes of day trading, right? Because let's think of a tightrope. So many Cirque du Soleil performances work off of tightropes or balances, right? So we're going to learn about trends and how to spot a good trend, how to stay away from sideways trends, and then understand how to use them for high probability trade setups. Now, before I go any further, I have an entire worksheet for you guys right here, completely free. You have to go right now. Let's do this together. makingofadaytrader.com. Go there, put your name in, and you'll automatically get this free PDF. It's a free document that I want you to follow along with me during this presentation. It's literally what I use for my own trading. And then with Anna sending the replay, you'll be able to watch and go over your document at your own time. So again, makingofadaytrader.com. Okay, makingofadaytrader.com. So go there, guys, and let's begin. But before we do, like I said, we are people, right? Sitting in front of a chart, we do not become two-dimensional. So I want to give you a little bit of intro of who I am. So I am Marina, the Trader Chick. I am actually an expat in Antigua, Guatemala. That's why I was asking where you guys are all from, because it's super cool that we are all from all over the world. So I live in Antigua, Guatemala, and I'm actually trilingual. I was a refugee from the Soviet Union over 40 years ago. So Russian is technically my mother tongue, right? Actually, me and Anna, when we talk, I try to speak to her in Russian as much as I can. It's not completely perfect, but I am fluent in it. English is my main language, as you could hear, because I was raised in the US, but I have now been living in Central America for almost 20 years. We lived in Costa Rica before, and now we've been living in Guatemala. Now, the reason why I bring up being trilingual, it's definitely something cool that I am very blessed to have. However, the reason why I bring it up is because of the way I understood trading. After a lot of years of struggling, I recognized that reading the market is literally a language. And when it finally hit me, it changed everything for me. So I don't know if any of you guys have learned second language or third language, but later in life, let's say around in your 20s, 30s, 40s, and up, it becomes very different. Like I learned English when I was 6. So I learned it literally within 2-3 months. I was pretty much fluent. The child's mind adapts so quickly, but when you're older, it's a little bit more complicated. And when I was learning Spanish, it was a really big process. Everything first had to go into my brain. I had to translate every single word, send it off to the person listening. Gratefully, people were really patient. Then come back, I had to translate. And this was a long process. It's the same thing as when you guys are reading your charts, especially in the beginning, right? It's a long process. What's going on? But then one day I woke up and it just clicked. I spoke Spanish. Not 100% fluently, but definitely I don't go through any of the process. I could be in a very cool conversation with multiple people. So, and that happened to me with trading. One day it clicked. But it clicked because I started from the beginning, and that's what I want to take you to, the trends. And before I became a day trader, I was actually a fitness instructor. Literally, I was teaching fitness class, aerobics classes all throughout Manhattan. And I was also a travel writer, and I still actually run my travel site. It's called Travel Experta because for me, travel is a necessity. And even though we haven't been able to travel that much, we are going to start again because obviously COVID. So just to let you know that I come from, I have a multidimensional aspect to me, and it's good to be like that. It's good when you bring in all these different aspects. Now remember, I have this presentation for you guys all via a document. Makingofadaytrader.com. Makingofadaytrader.com. You guys could see all of this and follow along beautifully. Makingofadaytrader.com. Okay, so every performer starts with learning the basics. This is how they have grown their confidence and trust, right? They mastered the basics. I can guarantee you, at least I know with my own journey of a trader, I did not start from the basics because the majority of the courses I took, they threw you in for you to follow a strategy and you didn't even understand what you were looking at. I always have an analogy to it that we were putting in windows before any of our walls were even built. And a lot of the times I was losing horribly, right? So that's when you could add those creative moves after you have built your walls, after you have learned the basics. Look, this guy, I don't know if you've ever seen these performances with these unbelievable moves on these ribbons 60 feet off the air. They began with their feet on the ground and just rolling that thing around their arms. Day traders need to start from the beginning, and that is what we're going to be talking about today. I'm going to focus on 4 strategies. They all come from trends. Okay, so if you ever think of a tightrope walker, they start with one small step leading to the others, usually on the ground, right? They don't get here right away, but the majority of the traders want to get here immediately and do it live without any protection, right? I'm sure that you guys have been there. I certainly know I have been there. So let's jump on that tightrope and dominate this. We could totally understand this. Remember, makingofadaytrader.com. You can get all of what we are now going to be going through together. All right, so let's get down to the basics. We all know that there are 3 trends, right? We all know that there are 3 trends. We know that there's an upward trend, we know that there's a sideways trend, and we know that there's a downward trend. These are just, we understand that logistically. However, 90% of our money that we make during trading or even, altogether will get lost. And I mean this, and you could go and check your journals, whatever your tracking systems are for your trades, they get given back to the market and usually a lot more in sideways trends. Why? Sideways trends are exhaustion patterns. They are indecision areas. They are the chop, if you guys have heard that, right? They are those channels. They are that grindy, there's no movement, right? So we have to understand when these sideways trends happen and stay away from them. And that is the goal. So just a quick review of trends because it's really important to understand the difference. What's an upward trend? It's literally when every pivot is higher than the other pivots, right? And it's going higher and higher. This is when you are going for a long, right? When you are buying at a smaller price to get out at a higher price, right? What is a downward trend? It's the opposite. It's when each pivot is lower than the other pivot, right? This is when you go for a short. This is when you are selling. You go in at a higher price to get out at a lower price and you take the profit in between. Before we move on, for day trading, we're not talking about investing, swing trading. I want to talk about day trading. If you guys are not doing shorts, if you are not shorting the market, you are not being 100%, because for day trading, we do not care if the market is going up or down. We only care about the technical analysis. And believe it or not, the majority of day traders probably make more money shorting the market than going up, going long. We need to take the emotion out of it. We do not care if people are losing here or they're gaining there, because it's all about us. Do you know those people that are losing or winning? No. So why do you want to compare and why do you care about them? I don't. I just know that the market is giving me all of the language and signs telling me to get into a short, and that's what I'm going to do. Okay, so you guys need to make sure that you are shorting as much as you are doing longs. Okay, now I personally am a scalper. I don't know if you guys know what scalping is, but intraday trading, you can turn intraday altogether means, you know, you're in and out of positions during the same day. However, scalping is going for much quicker time frames for smaller targets. I usually am in a trade between 1 to 3 minutes, right? In and out super quick. And that is so fun, and it is so rewarding because you are literally done within an hour and a half max, and that's usually because the day is super slow. And then I don't really recommend trading that day anyways, right? It gets really boring. So when you're scalping, you can have many trends that work the opposite direction, like here, right? Even though the overall momentum is headed up, it took this immediate momentum, which I could totally optimize before it heads back up in that direction, or maybe continues, but I want to focus and understand that as well. Okay, so before I continue, let me just see if you have, yeah, Abraham, I promise I will get to all of my EMAs. I'm going to show you my charts in the live as well, so you could ask me all of those questions as well. So let's talk about those sideways areas. What are they? They're called consolidation areas, transition areas. Just remember, they are literally the trader's worst enemy, and we need to understand how to spot them. Okay, so we have this downward trend. This is that sideways trend. It's a consolidation area, right? Which just happened to transition and change into another trend. This is what they look like, right? We're going to be talking about these areas because if you don't know how to use these areas, you won't know how to spot these, right? But it's really important for you to understand what these are. Now, the main reason why we lose money in this particular, in these sideways trends, it's not because of what the market is telling us, it's because of the stories we tell ourselves. Okay, so we tell ourselves stories. Do you guys understand? Do you know what stories are? Let me give you an example of a story. For instance, you have a good friend. Oh, no, sorry. You have a new friend. You just made a new friend and you really like them. You want to get to know them better. But, you know, when you're making new friends, there's always like, oh, you know, do they want to be with me, hang out? Like, it's a little bit of uncomfortability, right? But they invite you to a little get together, right? And they're like, you know what? I'll call you tomorrow. And I'll call you tomorrow and give you the final information. And you're all excited. This is cool. You're going to make a new friend. But all of a sudden, tomorrow comes and goes, and there's no phone call. So now you start to doubt yourself. Oh my God, did I say something wrong? Maybe they don't want to hang out with me. So you start to feel negative. You start to be, you know, giving yourself all this nonsense, right? The day after that, again, no phone call. Now you're definitely in all these negative stories. Oh my God, I guess I did something wrong. You know, we've all been there. And if you're telling yourself you've never been there, you're lying even more to yourself. We've all been there, right? But then 3 days later, this person calls, oh my God, I'm so sorry. I didn't call. My phone fell in the water. I lost everybody's contacts. So the whole thing that you were completely coming up with in your head, bringing yourself into a really negative place, was a story. It's a lie. There was nothing that made it real, right? But it became real in your head. These sideways areas are stories that traders tell themselves. This is how it works. There are 2 types of traders, and there's only 2 types of traders out of the 8 gazillion traders out there. One is the trend is your friend kind of a trader, right? They believe that when the market is trending, whichever direction, it's going to continue. So when they see this exhaustion pattern, they're like, you know what? The market is going to continue going high. I'm going in for a long. I'm going long. Then you have the second kind of a trader. It's the contrarian trader. They are always looking for a pullback, a retracement, a correction. That was me, right? So what I used to do, not anymore, but I used to do is, you know what? The market's been going up all day. It's got to retrace. I'm going for a short. And I used to go in for a short. Neither of those are true. They are both stories and they will both stop you out, right? So what is going on here? It's a story. So what is going on here? You have to cut the story out and be in the moment, focus and be like, you know what? The market is not going anywhere. It is flatline. I'm going to sit out and wait until it gives me confirmation of where it's going to go, because it can go either way. And I don't want to be 50-50. I want to be on the side of 80%. And that's what you have to do. You have to cut that story and be like, you know what? I'm sitting on my hands. I'm keeping my money in my pocket. And now these consolidation areas, they happen everywhere. Even little mini ones I really look at, because I'm going for smaller targets. So if I continue going down, I would have been totally stopped out, right? This is what they look like. And sometimes you could have consolidation areas pop up, consolidation area, mini retracement, and continuation. You have to know what you're looking for. Now, how do we recognize all this? Through areas. Look, the market respects areas, and we have to read what the market says, listen to the market, and respect it as well. What are those areas? Support and resistance areas. What is a support area? Support area is literally the floor of the market. It is literally where the market goes and hits 3 or more times, right? So when the pivots are coming and hitting each other, this is a support area. You have to draw it in. Support and resistance areas are like seatbelts. They're your safety mechanisms. You have to draw them in. You cannot do it mentally. When you're in that live market, everything goes out the window because your adrenaline is pumping too much. You need to have it drawn so that you know exactly what's going on, right? You have to have these areas drawn so you are ready and you understand. What is a resistance area? It is the ceiling. It is literally where the market hits the ceiling, the area over and over and over again. And it could sometimes repeat during your entire trading session. And lately, what I've been noticing, because we've been hitting all-time highs, resistance and support areas have been giving us channels for sometimes several days. I normally don't look at the days before, but if that area has been that strong the day before and it continued in the same day, I really need to understand it and respect it, right? Resistance areas or support areas, you have to understand them. You have to have them drawn in. Now, the main question is, how do you spot it in the beginning, right? Of course, once we spot it, that's understandable. But how do you spot it in the very beginning process of it? Reversal patterns. Have you guys heard of reversal patterns? They are double bottoms, triple bottoms, double tops, triple tops, head and shoulders, right? Reversals. This is a perfect example of a double bottom. Now, have you guys heard of divergence? I know that people use divergence. Look, I only use 2 indicators now. I used to use 3 monitors, 10 indicators, was in complete analysis paralysis all the time, total on stress mode. It was horrible. It was a horrible way to live, right? Because I didn't take that stress. I didn't shut that stress off when I turned off my charts. I used to take it out on my kids. I was too wired, and my husband. So when I came back with renewed energy and learned to read what the market is actually telling me, I put in 2 indicators. So you'll see my EMA lines, which I will go over and give you exact coordinates of that once we go live, and the reversal and the divergence. So the divergences come from the MACDs. In the bottom here, you see this? This is the MACDs. The majority of the indicators are usually lagging. They are not completely in the moment, right? The MACDs I find to be the least lagging. It is giving me really good sense of when there's starting to become a weakness in the market. And how do I sense that? Through divergence, and when it starts to get closer to the 0 line, that dotted line, that's the 0 line, right? So when I'm seeing divergence and there's a reversal pattern, I am completely out of the market. I know 90% of the time it's either going to go into consolidation or change direction, but I do not enter the opposite because it is not 100%. I do not know until it breaks through and gives me that confirmation. I am not anticipating or predicting. I am just seeing what's going on in the moment. So I personally love divergences even beforehand. As you can see, this pivot is way higher than this pivot, but it's completely flat here. So I would already not be in the market because I'm already seeing that the market is telling me it's slowing down. And I'm very conservative. I don't enjoy being in the market when I have even an inkling of doubt, right? They let murderers off for an inkling of doubt. Why would you get into a trade where there might be an inkling of doubt, right? Think of it like that. Okay, so with all those areas, now that you understand how to find them, and again, they're all in that document I gave you guys, makingofadaytrader.com. So we've all heard of breakouts, right? We know how cool breakouts are, but if you don't have your areas drawn in, how are you going to be able to spot it, right? How are you going to know when the breakout is actually happening if you don't have your resistance or support areas done, right? How? So let's put it all together. Remember, all of this is in makingofadaytrader.com. Makingofadaytrader.com. Okay, so let's talk about breakouts because breakouts are, without a doubt, the most popular trades there are. Why? Because it is giving us that extra confirmation. So what is a breakout trade? So let me, again, I'm gonna give it to you in total layman's terms so you guys really understand what is a breakout trade. Imagine you are going to a friend's house, somebody that you've been to their house a gazillion times, you know exactly where they live, you can go there with your eyes closed. So you live south of them, they live north of you. You get in your car, you hop on the highway, you're pumped with energy, it's all good, right? So if I was to bet on you, I would be betting on you right when you get out of the house that you're gonna make it there, no problem, right? However, all of a sudden there's a construction site and they close the highway and they're like, you got to go to the east, you got to go left, to the right, the road is closed. So during that detour, I don't know about you guys, but I freak out. I get stressed out. Oh my God, what if I don't know where I'm going? What if they don't continue with the detour? What if I get lost? What if they never reopen and I have to take these tiny little side roads? All these doubtful thoughts are going through my mind. What is those doubtful thoughts? Those are the consolidation areas, right? That's that uncertainty area. But all of a sudden, the construction worker opens the road and you're back on that highway that you totally know, and they're like, all right, road is open. Boom. You're back on that highway. You are super excited. If I was to bet on you to get there now super fast, I would get really well, right? With a trade. That's a trade. It is the breakout trade when you're continuing in the same direction because it showed that the market wants to continue there and it's renewed strength, right? But if you don't know where you have your area, you're not going to be able to take your trade, right? You're going to miss it entirely. So this is that breakout trade for me, right? Now, the way I use my MACDs and my EMA lines is for that confirmation. There's no divergence. Look at that massive run here. Look at that massive run. Look at that massive separation from the dotted line. This isn't hard, guys. This is not like super expensive softwares and algorithms. This is simply reading and seeing what the market is telling you. You are completely in control. When you are giving yourself over to algorithms and softwares, you're not in control of the market anymore. You're letting somebody else do it, right? And I've heard so many stories about these people that have all these automations and softwares and algorithms. None of them are making money. The only people making money are the ones selling it to them. And what really amazes me is the amount of times they have to pay for updates. So remember, if you don't control the market, if you don't understand what's going on in the market, you're never going to actually make it, right? You can't drive a NASCAR car in a race and have it on automation, right? They left you out of the race. It's the same thing here. Okay, now another bonus tip from Cirque du Soleil performers. And this is really important, guys, because I know for a fact that a lot of people do not have this. And that is another reason why they are not succeeding. Cirque du Soleil performers, they dominate one area. This woman, this is her thing, right? You're not going to see her hop on a motorcycle and do crazy tricks, right? You're not going to see her do juggling acts and clown stuff, right? Why? Because this is what she's doing. Why is it that every time I meet aspiring traders, they want to trade Forex, crypto, futures, stocks? You're talking four such different markets. And on top of that, let's say if they want to do futures, they want to go into E-minis, oil, wheat. I mean, does oil work like wheat? No. How could I possibly manage two different markets when I can't even master the one and completely different strategies and think that I could do it well? You can't. You cannot. So for day trading, you need to specialize in one thing, master it before you move on to the next one. Okay? Even good stock traders The majority of the times, like the ones that are equities, if you ask them, they normally maybe will trade only Tesla, only Apple, only Amazon. And if they want to get a little bit bigger, they might only focus on a sector. You maybe for pharmaceuticals, maybe only entertainment. You will never hear a pro do all. They will laugh at you, right? So it's really important. This is something you really need to understand. Okay? Aspiring traders figure out that multiple instruments is better. It's not. Remember, everything I'm telling you right now, makingofadaytrader.com. And now I want to take you guys for a really quick look into the live analysis. Okay, so before I go on, let me just show you my screen here of my indicators. I use 3 EMA lines. I use the 52, which is my main one, 52 period. Then I have a smaller time frame, which is the 20 EMA, and then I use the 135 EMA. Okay, and then my MACDs, they are just completely universal, totally universal. And again, you can get this any single good charting software. Charting software is a must. You can't drive a car without a car, right? I'm talking about buying extra indicators and softwares to put on your charting software. Don't do that. Okay, so here's a good example, right? This is from today. So we started the day with a pretty significant support area, right? And then after a market open, it finally broke through, right? And it continued to break through and do a really nice movement headed down. And then look at that. Look at this massive divergences starting here, right? And then from here to there, right? Look at this. Here, this is going down, but it's headed up. This is totally inclined while it's flat here, right? So I really, really pay attention to these divergences. And once it moved up, retrace, look at that massive area between the MACDs, total confirmation. I would be all over this trade. And this is how I watch the market all the time, right? And here is another example of that immediate, small, quick momentum that I was telling you guys about, right? I would be all over this. Look at this. It headed back down, totally crossed over my MACDs. I would be all over this particular trade. Again, I'm only going in for a box. One box is 1 point. So my scalping, I mean, I'd be in and out, within 30 seconds, boom, hitting all my targets almost immediately, right? I obviously have a very, very specific strategy that I follow, and I apply it to how I look at the markets, how I understand the markets, how I work with the markets, right? I can't exactly explain it all in 40 minutes, but this is how I view it. I never enter the market just because I think it's a good candle. I enter it by using my EMA lines and the MACDs. I use my EMA lines exactly like an archer does. Have you guys ever seen an archery competition? They don't walk around aimlessly on the field, right? They are very particular where they stand. And actually, if they put their foot a little bit too far, they might be disqualified. That's how strict it is. That's how traders should be. They should know exactly where they are out. I mean, where they are getting in and exactly where they are getting out. So they also have a target, right? Do you guys have a target? Do you have a stop in place? A lot of people focus on the stop in place, which is great, but you also have to have a target in place, right? Greed can really, really get you. So you have to understand that. Now, while I have my chart open, are there any questions at all? Because this is the time to ask me questions about the charts. Let me know. No? Okay. So if you have any questions, please let me know. And I am going to get back into the presentation here. And again, I am totally here for you guys for any questions that you have all the time. So please, please, please let me know. I really love to hear from you. You guys are in this presentation because you're struggling. You have questions, right? And it's normal and it's okay. And questions help you get better. Okay, now, wasn't that fun? Just like watching the market together, understanding all of that. Imagine if we could actually do this together every single week. I am so excited about this part of our presentation right now because this is where the most traders can do to unlock what is actually holding them back. And do you guys know what that is? The main thing is, how do they know they are doing it right? How do they know they are doing it right? Let me break it down for you. I've made something very special When you get the cheat sheet, you immediately get put on an exclusive VIP list. Okay, you get immediate access to a lot of different VIP offers. I want to encourage you to get this free cheat sheet because it could literally be the turning point for you. You will get a special invite coming into your inbox. Remember, makingofadaytrader.com. Only the people that are on this presentation live. Here's what I have for you. So a lot of people ask me if I have any sort of courses, and I normally don't really bring it up, but I do have this particular course that I call it my signature course. It's Simplifying Day Trading Futures course. It's my signature course, right? With a short bite-sized videos and explanations that literally show you what I do every single time I sit down to trade. And you could do it from any device. You could do it from your phone, from your computer, from your laptop, from your desktop, from your iPad. And it's literally in essence that I'm sitting with you side by side. But again, I could only make the special invite to people who get the cheat sheet at Making of a Day Trader. So make sure you do that and go to the link to subscribe to it right now. And on top of it, only now, only for you guys, if once you get my emails, I am offering a very special promotion, 6 months of working with me one-on-one for free. I sit next to you, we work together. Why? Because again, it's how do you know you are doing it right? How do you know you're doing it right? And if you do not have that proper accountability, that person that can help you, you're not going to be able to do it correctly, right? So remember, go to makingofadaytrader.com, get that cheat sheet, and automatically registers you for this special list, okay? And I'm giving you on top of that another bonus, another cool bonus. 6 months free in my live membership for the live trade chat room. Okay, it's 6 months of watching me in the live market, implementing it, but you're live with me, so it's more access. You can ask things in the moment. And not only do you get my mentorship for the 6 months, you also get this for 6 months, right? This isn't like me hiring a bunch of moderators. It's me literally live implementing everything that I teach right there with you, and you're asking me and implementing questions. And since I started this, I have had so many people go live because they're saying to me, I've seen you do this live, and I now am able to apply it in the same way. And a lot of times we do it live together as well. And that is a really, really cool thing. Now, because the program is so robust with so much information, you will literally have lifetime access, unlimited access to this curriculum. Okay, and the price, I'm not going to tell you, but one thing I will tell you right now, it is less than the average trade that you guys take. The entire course, including everything that I just offered with the 6 months of mentorship and chat room, this will literally cost you less than one trade. One trade that is usually donated to the markets. I know that, right? So instead of donating, you'll actually be able to put it into an education and then make it back 1,000 more times, right? Because the education is key. But here is the thing, guys. As with everything, there's always a catch. I only have 25 spots. I only have 25 spots available. Because of my one-on-one mentorship, I'm only able to take on 25 new students at this time so that you can have my full attention and commitment. So again, this is only going out to people that are live during the presentation. No one else is going to get this offer at all. So go here, makingofadaytrader.com. Go here right now. All right. And remember, when you get this cheat sheet, you get put on that list. Now, let me see. Are there any questions before I finish up so that I can help you guys? Okay, I'm seeing here, what are the 3 EMAs that you said? They were 20 period, 52 period, and 135 period. Now, it's one thing to understand that, right? It's kind of like getting into the NASCAR and being like, okay, so here's drive, here's neutral, here's reverse. But if you don't know how to maneuver it, it doesn't really go far. So having that information, you have to understand how to use it and a strategy to go with it, right? It can't just be 3 EMAs, boom, I'm in. You have to understand there's a strategy. And I really, really, really hope you guys are back testing, because without back testing, you're just asking to go into, losses. because back testing is the backbone of trading. And it's not back testing your day of overall trading, it's back testing each trade. Not only have I back tested each of my trade setups, I have a name for every one. I have also back tested divergence and reversal patterns to know that 90% of the time, that is when an area is starting to form or it's about to transition. I also know divergences 80% of the time is when the market slows down and is ready to either go flat or become a transition. This is called back testing. And if you guys are not back testing, you might as well just be donating money to actually good causes, because you will be giving your money to the markets. There is a very, very good, solid way to be a consistent trader, but you have to be committed. Remember what the beginning was? Commitment, discipline, trust, confidence. All right, guys. I hope that I was helpful in any way, and I'm always here to answer any questions. And thank you so much for your time and for being here. Thank you, Anna. I so appreciate being here again. And have a super day, everybody.
All right. Well, welcome everybody, and glad to have you guys on a Wednesday. Is it Wednesday or Thursday morning? I always get thrown off on these holiday weeks. But I appreciate you guys taking the time, and we'll make it worth your while with some really great information regarding how to adjust bad options trades. How many people have ever had a bad options trade? I'll certainly be the first to raise my hand. And the good news is there are some really effective techniques to fix bad options trades, and we're going to be covering those today on our session. So before I get started, I'll read a quick disclaimer. We know that trading securities and options, of course, involves risk. Prior to buying or selling an option, an investor must receive a copy of characteristics and risks of standardized options, and do need a broker to trade securities and options, and must meet suitability requirements. We will be going over some trade examples today, and just know that we don't guarantee that anyone will mirror the performance of the examples that we share. And of course, past results are not necessarily indicative of any future performance, although performance numbers that we show are based on trades users could enter based on our trade signals. All right, so we're going to start out by looking at two common products that I'm confident most people on the session will recognize. And the first one is WD-40. This is a common household item. Most of us have these in our cupboard somewhere in the house. The second one is the Nintendo gaming system. If you were alive or born back in the 80s, you'll probably remember this as kind of the start of the gaming era. And you may wonder, what would these two products have in common? Well, I'll give you a hint. It's not spraying the WD-40 into the Nintendo gaming system if you can't get the game to slide in, although I'm sure some of you out there have tried that. But they have an interesting thing in common that you may not be aware of, and that's that although they're both very popular and successful items, they actually both failed in the beginning. So if you look at the Nintendo gaming system, we know it today as one of the most popular gaming systems that really launched an era, but believe it or not, it didn't start out as a success. In fact, Nintendo's first offering, which was the Famicom console, had to be recalled after the first few months on the market. And then you may also recall the popular gaming system Atari. Believe it or not, that one actually failed in the mid-'80s, and it really shook up the gaming industry and left that whole market a real mess. And then to try to combat that, Nintendo came out with the NES system, which you may recall, and that actually barely even sold when it was introduced in the mid-'80s. So interestingly, although it became a big success, Nintendo actually failed in the beginning. And it wasn't until '86 when they made a little adjustment to their business model and introduced two little characters that you see there on the screen, as we know today as Mario and Luigi. And that simple adjustment to their business model, in addition to the gaming industry, changed it forever. It launched a whole new era, which then resulted in an explosion in the home gaming industry and a success of the Nintendo gaming system. Now, WD-40 is another interesting case study because it actually failed quite a number of times, and I'm curious to know if anyone in on the session today knows where WD-40 got its name. You'd be surprised, and it's almost hard to believe, but the fact is, it got its name because it was the 40th attempt to create a degreaser and rust protection solvent. So this company actually failed at making this product 39 times before it was successful. And it became popular because its employees actually realized that it was a great lubricant for home use and started to use it for that purpose. And then it was eventually released into aerosol cans in the late 50s. So imagine if the lab had given up after 39 tries, we wouldn't have a WD-40 today. And so it's pretty incredible how some of these case studies show us that even though very popular, successful products have failed so many times, these companies were able to make some tweaks and adjustments to their products and business models that ultimately allowed them to become successful. And the reason I lead in with this is because we can make similar tweaks and adjustments to our trading business that can allow failures to become successes. And the good news is we won't have to generally take 39 tries to make a trade successful. Typically, we can do that in 2, 3, or maybe 4 adjustments. And so that's what we're going to be covering on our session today. And we're going to specifically focus on options because the options market has just exploded since last year. And I took this screenshot from CNBC from an article that was published back on December 4th of 2020. And because of the pandemic and more people losing their jobs and staying home and searching for alternative ways to make income in the markets, we've really seen an explosion driven by the pandemic in the options market. And if you look at data from Piper Sandler, they found that equity options trading is 50% above 2019 levels before the pandemic occurred on all options platforms. And if you look at just the equities options volume, the NASDAQ's up 49%, the CBOE's up 51%, and the ICE is up 58%. That's a huge increase in trading volume in the options market. Now, that's great news for brokers. Unfortunately, it's probably bad news for a lot of aspiring options traders because most options traders, as we know, fail in the long term because they don't have a backup plan or ways to adjust their losing trades. And those are the tools that I'm going to give you today on our session. So the reason very few traders make it, and there's many, many reasons, of course, why we fail at trading. And there can be many causes that lead up to that, but ultimately it's the losing trades that wipe out profits from our winning trades that result in the low success rate for traders and investors. So the nice thing about the trading business is we have very low overhead, right? We have low operational costs, and those have even improved recently with zero commission brokers. So prior, it was really the commissions and fees that were our overhead. Of course, you need a computer and an internet connection to trade, but compared to most businesses, the overhead is very low. Where the real overhead comes in is in losing trades. Those are our real expense in our trading business. Now, the good news is up to 75% of the losses that traders experience can be fixable and avoidable. Now, most people who try their hand at options trading aren't aware of this. They think that if I go ahead and enter a trade, an option strategy, that the outcome is binary. I'm either going to win or lose the trade, and there's really nothing I can do to manage that in between. And that's simply not the case. A lot of the losing trades that we inevitably face in the options market can be adjusted. And that's one of the beautiful things about options is that they give us a lot of flexibility to make adjustments and turn things around when they don't work out. And certainly some losses are a cost of doing business. You can't avoid all losses. That is our main overhead in the trading business. But a lot of them can be turned around and avoided. And as you'll see on our session today, I'll show you how you can even take some very catastrophic situations and turn them into really big successes using a few simple tweaks. So imagine if you could take a popular option strategy like the Iron Condor. This is a four-legged options strategy. It's an income-based option strategy that a lot of traders attempt, and take a losing Iron Condor trade that is down $3,900 on the S&P and make a few simple tweaks to that trade and turn it into a $2,400 winner. Sounds pretty nice, right? Or how about another popular option strategy, a vertical spread or a credit spread, also an income-based strategy, and take a trade on the Qs that's down $580, making a few simple adjustments and turning it into a $620 winner. Or how about a naked put? This is another popular option strategy that many traders avoid because they're fearful of the potential risk being an uncovered option strategy. But imagine taking a losing put that's down $730, making a few simple tweaks and turning it into a $540 winner. Well, here's the cool thing. These aren't hypothetical results. These are actual trade alerts that we sent out to our members that didn't initially work out as we intended, but we also instructed our members to make a few simple tweaks when the trade moved against us and resulted in the outcome that you see here. Pretty incredible, and I'm going to show you how we accomplished this. Now, let's look at one popular adjustment strategy on a naked put. So this is a screenshot of my personal real money TD Ameritrade account back on August 24th, 2015. How many people remember what happened on that day? Go ahead and put that in the chat box. Yep, that's right. It was the flash crash of 2015. So if you were trading back then, you'll recall that the market opened down. I believe the Dow opened down over 1,000 points at the morning. I'm in the Mountain Time Zone, so this was 6 minutes. The screenshot was taken 6 minutes after the market opened. And all of these positions in my account were naked puts. So a naked put is simply when you sell to open a put option, and the intention is for the stock to either stay flat, decline slightly, and stay above your strike, or go up. In this case, as you see on the percent change column, every single one of my naked puts was down. In fact, many were down quite significantly, double digits, 12%, 10%, 14%. Yet my P&L for the day, 6 minutes into the open, was over $7,600. So normally when the stock is down, the P&L should be down if you're short a put. So how was I able to have an open P&L of $7,600 when all of these positions were down so significantly at the open? Well, it was by using a simple adjustment technique that I'm going to share with you on our session today. So I'll give that to you. I'm going to spoon feed that exact adjustment technique that I used to accomplish that on that morning of the flash crash, and I'm going to give you the formula that allowed me to do that. And the cool thing is there's an adjustment to fix virtually every bad options trade. In fact, there are often many different types of adjustments we can use. And over the next hour or so, I'm going to give you some of my most effective adjustment techniques to fix losing options trades. All right, so we're going to look at things like taking a credit spread, which is a popular option strategy. It's a vertical spread where you receive a credit or deposit into your account. Taking a losing credit spread and using a delta neutral hedge to turn it into a winner. Or how about taking a losing naked put like we just looked at in my personal trading account, using a horizontal roll and turning it into a winner. Or a long call and converting a losing long call into a vertical spread to turn it into a winner. And we can't turn every losing trade into a winner, but often we can make adjustments that mitigate the loss, reduce our risk, and oftentimes we are able to turn those into winning trades. So before I get into some of my best adjustment techniques, I'll give you a little background on myself. If you haven't attended any of my past educational events, I do have 20 years of experience trading the stock, options, and futures markets. I received my professional training at Morgan Stanley, and I'm the founder and chief investment strategist of Altos Trading. Currently have over 30,000 members in over 100 countries across the globe. I'm also a professional money manager, so a lot of the techniques and tricks I'm going to share with you on our session today, I also use in my hedge fund, Altos Capital. and I'm the founder and the creator of Trade Trend Signal software. Now, by the end of our session today, you'll discover how to fix losing options trades and even turn a lot of those losers into winning trades. And I'm going to reveal some of my top trade adjustment tricks to reduce risk and increase potential profits. So whether you're just starting out or you're a seasoned options pro, this is really must-have information for today's markets. So let's start out by looking at one of my favorite strategies, selling puts for income. So this is a really effective strategy when executed correctly with the right risk parameters. A lot of people shy away from this strategy because they perceive it to be very risky. And we're going to talk a little bit about why that's not the case. But if you're not familiar with a short put or a naked put, it's when you sell to open put options and you collect a premium or credit in your brokerage account for entering this trade. So when the stock rises and the put options that you sold expire out of the money, you get to keep the entire premium you collected when you sold them. So let's look at a quick example of what that looks like. If we sold puts on ABC stock, which let's say is trading at $100 per share, and we select a 95 strike price, let's say we collect $2.50 per contract, and the contracts expire in 14 days. So since each contract controls 100 shares of stock, you receive an immediate deposit of $2,500 into your brokerage account before commissions and fees. And as long as that stock stays above $95, which is our strike price, by the time expiration comes around, you keep the entire $2,500 premium you received when you initiated the trade. Pretty cool, right? But there's a common misconception that selling naked puts is extremely risky. But in fact, selling puts for income has a similar risk profile to buying stock or writing covered calls. It really only becomes very risky if you over leverage your account and use too much margin. But when done correctly, it can be an incredibly consistent method for collecting income from the options market. And in fact, it's how Warren Buffett often acquires stock. Now, the fact is that the single biggest difference between amateur traders and professional traders is the ability to adjust losing trades. So just like any other strategy, things will at some point inevitably not work out with a naked put. And it's important that you know how to make an adjustment to that trade. So most traders enter a trade and cross their fingers. They only have one exit strategy, win or take a loss. And oftentimes with income-based option strategies, that loss can wipe out a series of winners. The fact is, when a trade doesn't work out as intended, it doesn't have to be an inevitable loss. There are simple tweaks and adjustments we can make that can often save the trade and even result in greater profits. So let's talk about what happens when things go wrong. Well, first of all, we have a primary exit strategy. So for a naked put, that would be when the put expires out of the money and we keep 100% of the premium collected. In other words, the underlying stock or ETF that we write the puts on finishes above the strike price at expiration, and that occurs about 85% of the time. So about 8 to 9 times out of 10, we don't have to make any adjustment to the trade. But that 10 to 15% of the time, when things don't work out as we initially intended, we need to have a secondary exit strategy or a backup plan. And that's where we would implement an adjustment technique. And one of our favorite adjustment strategies often results in even greater profits. So let's talk about how to adjust a losing short put. Now, remember that screenshot I just showed you of my personal TD Ameritrade brokerage account on the day of the flash crash. Okay, the market opened down, gap down really big, putting me at risk and vulnerable to declines in the underlying security, yet using an adjustment technique that I'm going to share with you, I was able to open up with a P&L of over $7,600 that morning. So there are really two common adjustment techniques that we use to adjust naked puts. The first one is rolling. So rolling simply involves closing out our initial trade, our short puts, and opening a new trade at a further out expiration. And we use the same strike price and the same number of contracts. And the reason we do that is we want an equal or greater credit or deposit into our account. And I'll explain that in more detail, but we want to stay net cash positive. And in fact, this is the sole adjustment strategy we use in our put writer alert service. And it's allowed us to close 237 out of 237 winning trades going back a little over 5 years. So again, about 85% of those we don't need to adjust. The other 15% we do, and it's allowed us to recover every single losing trade we've encountered in that service. Now, the second technique is called delta neutral hedging, and this is actually the technique I used that day of the flash crash in 2015. So I'm going to give you the formula for delta neutral hedging, and I'm also going to go over some rolling examples. But to give you a basic understanding of what delta neutral hedging is and how to apply it to a naked put, in order to transform a naked put into a delta neutral position, and by the way, you can neutralize the delta on virtually any option strategy. But for a naked put, all you have to do is buy to open enough at the money or near the money put options in order to completely, or as completely as possible, we often can't completely neutralize the delta, but we want to get it as close to zero as possible, offset the delta of your existing short put options. And by executing this adjustment, if the stock should continue to fall, you will profit on the put options that you purchased. And this will offset losses on the ones that you sold if the stock continues to move lower. And we typically do this if our short puts move in the money aggressively. So let's go back to this day of August 24th, 2015, the day of the flash crash. And now I'm going to give you the formula I used to delta neutral hedge every one of these short put positions in my personal account. So here's the calculation. First of all, we take the number of contracts and we multiply it by the delta times 100. And the delta can be obtained on any options trading platform in your options chain. And that's going to give us the position delta. We then divide the at the money option delta by the position delta to get the number of contracts to buy. And the result is a delta neutral hedge that can profit on a decline in the underlying security. And that's because the long options that you buy are going to offset and eventually outpace the losses that you experience in the short put if the underlying security continues to move down. So let's look at an example on an options chain. This is just kind of a generic example. Let's say that we had sold puts at the 58 strike on this particular stock. And you'll notice here that the 58 strike has now moved into the money. In other words, the underlying stock has dropped below 58, exactly what we don't want it to do, okay? So what we would do using this calculation is we would first get our position delta. So you'll notice the delta there, and you can ignore the negative, is 0.59, okay? And to get our position delta, we take the number of contracts, and in this example, we're using 10, and then multiply it by the delta times 100. So that's where we get the 590. That's our position delta. All right. And then we take the strike price that's nearest to the at the money strike. In other words, the strike price that's closest to the price the underlying stock is currently trading at, in this case 57, and we divide that delta into the position delta, and that gives us a number, right? So in this case, it's 12.29. Now, we can't buy 12.29 contracts, so we either round up or down to the nearest number, in this case 12. So we would buy 12 contracts at the 57 strike to neutralize the delta in our short puts. Okay, so we're buying 12 57 strike contracts, and that gives us a delta neutral hedge. And so if the underlying security continues to go down, those 12 57 strike contracts will offset and even outpace the losses in the short 58 strike options. And that's how you create a delta neutral hedge. And this is what I did on the day of the flash crash. Now let's go back to the rolling adjustment. Let's take a look at an example. And this is actually a real life example from our trade alert service. And it's one of our worst case scenarios. And I like to share our worst case scenarios to show you what's possible when things don't go well. So on August 10th, we alerted our members to sell puts on Sienna with an August week 3 expiration at the 24.50 strike for $27 a contract. Okay, so if you were writing 10 contracts on this alert, you would have collected $270 before commissions and fees. Now, unfortunately, the trade didn't go as we expected. Sienna started to move down below our strike price. So on August 18th, we alerted our members to execute a rolling adjustment for a $1 debit. And we alerted them to roll out to August week 4. So just out 1 week at the same strike price for $110 a contract. Now notice what's happening here. Our net credit is positive. So we were debited $1, but then credited $1.10. All right, so we're staying net cash positive. Now, unfortunately, the stock didn't quite recover to where we wanted it, but we were able to pick up some profit on that rolling adjustment. On August 25th, we alerted our members to roll again, this time for a 52-cent debit. So you'll notice that we picked up some profit on that rolling adjustment from the previous 110, and we roll out to September week 2. This time we're able to roll down in strike price to 22.50. So this is what's called rolling down and out. So we're rolling down same number of contracts, 22.50 strike for $58 a contract. Notice the credit's greater than the debit. Now, the stock continues to go down. On September 8th, we roll again, 85-cent debit. We go out to September week 4, a couple more weeks, same strike price, $22.50, $100 per contract. I said this is a worst case scenario. We're on to another adjustment September 22nd. This time we collect a bit of profit on the rolling adjustment. Roll out to October week 1, a 90-cent debit, same strike price, $103 per contract credit. Finally, on October 6th, just a little less than 8 weeks later, we close the trade at a 17-cent debit. And the key here is that Sienna never actually recovered above the initial strike price from our trade back on August 10th. But we were still able to close this trade out due to staying net cash positive on the rolling adjustments and taking advantages of fluctuations in implied volatility to close the trade at a $540 profit per 10 contracts traded. Now notice back on August 10th, we initially collected a credit of $27 a contract, or $270 per 10 contracts. So we came out with a better outcome than we would have came out with if this trade had initially worked out. So rolling actually took this from a losing trade, not only a losing trade, but also an outcome where we ended up with a better profit than the initial potential. And that's the power. And it works because it allows us to stay net cash positive while taking advantages of decreases in implied volatility and increases in the underlying share price. Here's another example. This one's didn't quite take as long to work our way out of, but similar situation where on September 12th, we alerted our members to sell puts on Micron, the August week 4 expiration, 44.50 strike for $55 per contract. The stock moved down. So on the 27th, we rolled Micron out to October week 2 at the same strike for a 119 debit and collected a premium of $216 per contract. On October 11th, the stock recovered and we were able to close out the Micron trade at a 52-cent debit. Now, the key here again, because most people think, well, the stock has to go back up above your strike price. Well, no, it doesn't, because we are collecting a surplus of credit relative to the debit on the rolling adjustments. So at expiration, the stock was actually sitting at 43.59 when our initial strike was at 44.50. And the result was a profit of $820 per 10 contracts traded. Now, again, notice on September 12th, when the alert was issued, the profit potential was $55 or $550 per 10 contracts traded. So we increased the outcome or the final profit relative to the potential from the initial alert. So rolling has a silver lining, and that is that you don't have to recover past your short strike in order to be profitable. And since we're staying net cash positive with the rolling adjustments, the net credits over time can offset the debits. So the reason that we prefer selling options or strategies that result in credit to our account is because it simply has better statistical odds than buying options, or even that a casino has over its customers. And we all know that even the very small statistical edge that casinos have over their gamblers, they come out ahead in the long run. And so the beauty of an option selling strategy is you have 3 ways to win. You win if the stock goes up, you win if it stays flat, or you win if it moves down slightly, even against you a little bit. And there's really not many other strategies that you can have so many different outcomes and still make money on the trade. And it allows time decay to work in your favor, and it has more room for error. And it's typically easier to make adjustments to these types of strategies. Now let's go on to one of my other favorite option selling strategies, and those are credit spreads and iron condors. And they're a really popular option strategy among options traders, whether you're just starting out or many seasoned traders also implement these types of vertical spread strategies. But basically, they're created by buying cheaper options contracts and simultaneously writing an equal number of more expensive options contracts. And a credit spread is an option spread that you're receiving cash for or net credit into your account. And this credit to your options trading account is why such spreads are known as credit spreads. Now, an iron condor is simply the combination of two credit spreads. It's a bull put spread and a bear call spread on the same underlying security with the same expiration. And the reason I love iron condors and credit spreads is unlike most option strategies that options traders attempt, like buying a long call or a long put, you have to hit a bullseye with those strategies. You have to be exactly right on the timing. You have to really do your analysis on the Greeks, the deltas, the gammas, thetas, and you have to really time the movement of the underlying security very precisely. So that's why they're very difficult. And a lot of other variables come into play, like implied volatility. So traders make mistakes like, buying options when the implied volatility is too high. So there's a lot of things that can get in the way of success. Now, with iron condors and credit spreads, we don't have to hit a bullseye, right? We can throw the dart really all over the dartboard and still come out ahead. So let's talk about how to adjust a losing credit spread or iron condor. We can also use the same adjustment technique that we looked at with short puts, and that's delta neutral hedging. So in order to transform a credit spread or iron condor into a delta neutral position, if either the short put or short call in your spread is breached, we can close half of the contracts at the breach strike, and this will help offset losses and even produce a profit if the underlying continues to move past the spread. And it can produce winning trades with a profit greater than the initial credit, just like we looked at with the short put examples. Okay, so let's take a look at an example from our alert service. We also run an alert service on credit spreads and iron condors. So on June 15th, we alerted our members to open an iron condor on the S&P 500 index, the SPX, with a June week 5 expiration. And for that, they would collect a $110 per contract credit. So if you're trading 10 contracts, that would be an $1,100 credit to your brokerage account. Now, unfortunately, in this example, the S&P shot down and breached the 27.25 strike puts in the spread. And on June 25th, we had to alert our members to a trade adjustment. And at the current time, on 10 contracts, the position would have been down $3,900. But on the next trading day, June 26th, we alerted our members to adjust using a delta neutral hedge. In other words, to close half of the 27.25 strike puts. And then the very next day, June 27th, we alerted our members to close that S&P iron condor for $250 a contract, profiting $2,400 per 10 contracts traded. So we took what was a $3,900 loser and turned it into a $2,400 winner. And that's the magic of delta neutral hedging. When the underlying continues to move in the direction of your breached vertical spread, it can turn a losing position into a profitable one. Let's look at another example. This is on Apple. So if you look at the Apple chart, you'll notice that there's a pretty nice resistance level right around 125. And this is what we look for when we open vertical credit spreads, is either a support or a resistance level. In this case, it was a resistance level where we would open a bear call spread, right? And we want to open it right around or past that strong resistance level. But you'll notice, unfortunately, after we would have set this bear call spread up, Apple shot up through that 125 strike. This is what we don't want to happen. But let's take a look at what would be possible if we were to make an adjustment to this trade. So in our initial vertical spread, we would have a 125 strike, that's our short strike, and a 127 for our long for a $59 per contract credit. All right. Now, if you'll notice, that day that the underlying stock, Apple, breached the spread, in other words, the stock traded through our short strike at 125, there was a $560 open loss in the position. So this is another way to create a delta neutral hedge, is we take the strike price right in between our spread. In this case, a 125, 127 strike spread. We would select the 126 strike, the strike price right between our spread, and we would purchase options at the same strike price to offset or hedge the initial credit spread. In this case, we selected 10 contracts, the same number of contracts in the initial spread. That would be an aggressive adjustment. At the very minimum, you want to look at using probably around 2 to 3 contracts for every 10 in your spread, on a more conservative side. And you wouldn't want to go over the number of contracts in your initial spread. So in the initial spread, we had a $560 loss. We hedged with a 126 strike. The stock, as you saw on the chart, continued to move up. Okay, so now we've got a 126 strike call in between, plugged right in there in between our 125 to 127 strike puts or call spread. Now let's take a look at what happened at expiration on December 31st. The stock shot up, and our initial spread, had we not made an adjustment to it and just left it alone and hoped for the best, had a $1,385 loss. But then take a look at our 126 strike call hedge, a $6,300 profit. So by executing this adjustment, the potential was to turn what would have been a $1,385 loss into a $4,915 profit. So this is the beauty of delta neutral hedging when it works out, and we take what would have been a losing spread and turn it into a winning spread. Now here's a few crucial tips to adjusting trades. Trade adjustments can be both defensive and offensive in nature, but the key is your trade adjustment must match the strength of the move in the underlying security. So in this example that we looked at with Apple, the stock was making a strong move, so we made an aggressive adjustment by using 10 contracts. Now if the market's in a sharp decline, a delta neutral hedge can turn losing trades into big winners. That's the potential. And if the underlying slightly breaches your spread, rolling might be a more appropriate adjustment that can help you ride out the trend until it reverses. But the trick is with adjustments is not only knowing how to execute, but when and what to adjust. So now you know that up to 75% of losing trades are avoidable, and there is an adjustment to fix virtually every bad trade. In fact, there are often many different types of adjustments we can make to options trades. And I revealed a few of my most effective adjustment techniques to fix losing options trades. And this is why I do it, guys, because I do trade for a living, and as I mentioned, I do manage money for my clients, as well as run many successful trade alert services for our members. And the reason that I love to trade is not because I like to sit in front of a computer and stare at my brokerage screen. It's because I like to get out and do the things that I love to do, like fish, ski, and travel. And this is what we strive for our members, is to be able to achieve the lifestyle that they're looking for and spend the time doing the things that they love to do and not sitting in front of a computer all day. So we all know that time is not money. Time is the most valuable resource on the planet, and you can't earn or create more time, and you certainly can't get it back. Money, on the other hand, replenishes. So I used to trade my time for money. I used to work a 9 to 5 day job, but now I trade so I can have time, and that's what we want for our members. And for that reason, we put together a really cool membership package for the InvestorExpos event, where you can get access to three of our best trade alert services: our put writer strategy, our iron condor and credit spread strategy, and our stock trade alerts, where you get access to 12 to 15 real-time alerts per month, and you don't have to sit at your computer all day trading. You can get out and do the things you love to do, because we send all of our alerts out after market hours. And the typical holding period is only 14 days, with an average win rate of 85% for all three services. And as I mentioned, that we've closed 237 winning trades in a row in our put writer service. It's unprecedented, guys. I don't know of any other alert services out there that can do that and that also offer you trade adjustments for when things don't work out. In fact, here are results from our put writer service going back to 2016. And even in 2020, where we had a 32% sell-off in the market during the Corona crash, we were still able to come out with incredible results for the year. These are based on 10 contracts traded and do include trade adjustments and don't include commissions or fees. But check out that P&L, guys, going back to 2016. And this is just for one of the 3 services that we're throwing into our package today. So we've developed this to help our members earn while they learn. So if you want to be successful at something, you need to find someone who can achieve the results that you want and copy what they do. That's a really incredible, crucial quote from Tony Robbins that I love because it couldn't be more true. And we're putting this package together for you because I want to help guide you with live trade examples that reinforce what I've taught you in our session today. So I've given you some really good actionable information, but I want to help take you a step further and show you how I do it in real time and how I adjust losing trades with actual trade examples. And here's a bonus tip. This is what a lot of our members do. They use the trade alerts to reinforce the knowledge that we teach our members in the training like you've learned today to improve your proficiency and raise your confidence. So this is kind of what an alert, standard kind of typical alert would look like. This is one that we issued on the TLT. It was an iron condor trade alert back on January 3rd of 2020. And our members were able to achieve a 48-cent credit per contract or $480 per 10 contracts traded. Now, this one worked out really nicely. We didn't have to adjust this one, but I just want to give you an idea of the types of returns that are possible on alerts like the Iron Condor. In this case, the absolute return before commissions and fees was over 19% and only 14 days. That's an annualized return of over 495%. I don't know if you guys are seeing returns like this in your own account, but this is what we do on a regular basis for our members. This is an example of a stock alert on Morgan Stanley. We alert our members to get in at $52 a share. At the time, the stock was at $52.06, and we alerted our members to close it on January 16th at $56.05. We were in the trade for 13 days. That's an annualized return of over 266%. Now, this is another example of kind of a really worst case scenario. I'm running a little short on time, so I won't go into this in a lot of detail, but it was an alert we sent out on Las Vegas Sands. The stock lost 45% of its value. And initially this credit on this trade was $70 per contract, but we turned this situation for our members into a massive $1,495 per contract winner. We went from $70 at the onset, turning it into $1,495 per contract. Okay, that's 21 times the initial profit potential. These are the kind of results we produce for our members. So I'm going to tell you guys a little bit about the package we're offering up today and what you will get with it. So the first item is 12 months of our top 3 options and stock alert services. Now, if you went and bought these from us at retail value on our website, that would cost you $1,499. We're also going to throw in all of our trade adjustments to fix losing trades, and we're actually going to teach you those as well in one of our courses. That's a $299 value. And you also get that course, the Professional Trading Series. It's an online course with over 9.5 hours of content that teaches you all of our best strategies. So we don't just give you the alerts, but we actually teach you how we trade these strategies, as well as implement the trade adjustments for a $997 value. If you're a Facebook member, we give you access to our Facebook group. That's a $199 value. We have over 800 members now in our group. So you can interact with all of our other students and learn and share stories with our group. And we're going to teach you all of our adjustment techniques. Nothing held back for all of our strategies that we implement in our alert services. That's a $900 value. And as I mentioned, the alerts are delivered after the market closes, so you don't have to day trade. Well, if you have a full-time job or you're retired and you want to go out on the golf course or do whatever you love to do, these alerts come out after market hours, and you have all afternoon and evening and the next morning before the market opens to enter them with your broker. And again, you get 12 to 15 real-time trade alerts per month. We have over an 80% win rate across all services, and ultimately you get to learn to trade stocks, futures, forex, and options with consistency, and that's really priceless. So the total value on our trade alert package is over $3,800. We're taking 75% off the retail price today and offering it up for only $997. So guys, that's less than $3 a day to get access to 3 incredible alert services with a strong, proven track record going back over 5 years. Now, we are going to limit this to the first 10 members that join us today. So we're throwing up 10 seats at this special offer today. Once those sell out, we will go ahead and take the offer down. So I hope you claim one of the 10 spots and get access to everything you see here on your screen. And I believe Anna will put this in the chat box for you guys. But the link to join and claim one of the 10 seats today is altostrading.com/bundle. Again, altostrading.com/bundle. And you get everything that you see on the screen, including access to our best trades in real time. You don't need to sit and watch your computer all day. They're sent after market hours via email with easy to read instructions, including charts and order entry screenshots. And we give you all the rationale behind why we're issuing the alert, including trade adjustments. So whether you're a beginner or you're a seasoned trader, this really works for everyone. If you have a full-time job, part-time, or you're retired, no problem. We have members of all different skill sets and lifestyles, and all over the world. We have students in over 130 countries, regardless of what account size you're starting out with, whether you're just trading one contract or 100, we have members of all across the spectrum, of all levels. Traders who want to learn how to trade on their own, or traders who want to be spoon-fed. Whether you're looking to learn this and ultimately not take the trade alerts, we have members who do that. Some members just love having all the hard work done for them and just getting the email. We have a lot of positive testimonials from our alert service members. All right, so we have members. One of them that I really love that I'll pull out of here is from Winford. Winford's one of our longtime members that joined the put writer in the Iron Condor service. He didn't, I don't believe, got access to the bundle service that we're offering up today, but he joined these alert services individually, and he's a retired law enforcement officer. So he really wanted to be able to spend time away from his desk and computer and enjoy life as a retired law enforcement officer. And he tells us that he benefited tremendously from just these 2 alert services alone and earned over $90,000 in 1 year trading the services. Really incredible. So guys, I'm going to throw in a guarantee as well. If you aren't profitable trading the alerts in the first 90 days, we're going to give you $1,000 out of our pocket to spend on any of our highly acclaimed online trading courses, coaching services, or our trade trend signal software. And we'll give you an additional year of the trading alerts on us. That's how much we believe in our products and services and how dedicated we are to seeing you guys succeed. So guys, what happens next? First, you're automatically added to our members list for trade alerts and directed to the Trade Alert membership registration page. And then once you're registered, you're going to receive a confirmation email in a few hours confirming your access. And you'll get exclusive access to our professional trading series and members only portal. And then we're going to throw in 2 bonuses. As I mentioned, you're going to get the professional trading series online course, over 9.5 hours of online training, including our best stock options and Forex strategies, as well as trade adjustments. And then bonus number 2, my ebook, How to Create Risk-Free Trades and Let Your Profits Run with Little or No Risk. This is a really cool money management trick that can help you mitigate losses in virtually any strategy you're currently using, including the trade alerts that you'll receive in your package, or even help you eliminate the risk completely in some of your trades while still allowing for potential profit. Now, I went a little bit over here, guys. I'm not sure if Annie will give me any time for Q&A. If I don't get to questions, you can always email us at support@altostrading.com or give us a call at our toll-free number, 800-895-9348. But once again, go to altostrading.com/bundle to take advantage of everything you get here on your screen. We are limiting this to 10 seats. You do get 75% off the retail price, so I'd urge you guys to take advantage of this today while it's still available. And with that, I will pass it back over to Anna.
Thank you so much, Jeff. I posted all the links into the chat box, and excellent. It was a great presentation.
Thank you so much. Appreciate having you. And sorry I ran out of time for Q&A, but guys, if you have any questions, again, shoot us an email, support@altostrading.com, or give us a call toll free.
All right. Thank you, ladies and gentlemen, for joining us. We're going to talk about what we call a weird, or at least some people call it a weird strategy, and it's a bit of a secret. You probably have never seen it or heard of it. And we're going to talk about automated options trading, something that's also quite unique. We're going to look at stock indexes, trading those in all directions, and then also how to automatically manage your option trades with risk and reward parameters. And we're going to look at one-touch trade alert, something you've never seen before. And we're going to go ahead and take a brief moment here to mention risk. And while I do that, just so you know I'm real, let's see if I can show you my screen. Okay, there we are, folks. I'm here. So we'll keep that up for just a moment, but then we'll shut that down a little bit later to get more room on the screen. But remember, we're speculating, and there's always risk when we're speculating. So do take a moment to look at the risk disclosure. It is important. Remember, all funds should be risk capital when you're trading, and past performance is no guarantee of future results. We're going to look at algo-generated option spreads, pre-built option trades with one-touch trade alerts, a very unique approach, automated risk and profit controls. And we can do this in bull, bear, and even non-directional markets. So if you like what you see, we're going to show you how to take action at the end. So stick around. We have a lot to cover. And a little bit about who we are. That's yours truly there. We're down on the trading floor with some of our staff trading S&P 500 options. That was several years back. And of course, the trading floor does not look like that anymore. People have been, I guess, relegated to the sidelines because of the machines. But we've been doing this since 1997. As an introducing brokerage firm, all of our staff have multiple decades of experience. We're regulated, of course. We're located in California, and we've traded tens of millions of options and futures over the years. There's a picture on the trading floor. I believe that's New York, Coffee, Sugar, Cocoa Exchange. So really with all that experience, what we want to try to tell you is don't try to figure everything out by yourself like the mad scientist here. You see the stock ticker is figuring out the stock prices with his research here in his basement. So use our help, use our decades of experience and development from industry veterans. We're going to show you this technology. And a little bit about myself. I'm Erik Gebhard, been doing this about 30 years now. I started back in 1991. I have my BS in business administration from the University of Southern California, and I'm also a co-founder of AltaVest. And there's my textbook. Enjoyed that class, learning investments, derivatives, so on and so forth. There's our section on options and modeling, pricing, and all that, but you don't need to worry about all that. But that piqued my interest. We were looking at crude oil and gold prices at the time, jumping in value because of the oil fields in Kuwait burning. That was quite a interesting time in terms of a narrative to learn about the markets. But I was in the securities industry for a time with my Series 6 and 63 licenses and mutual funds, but I enjoyed futures, and that's where I ended up. So that's where I've been ever since. So with that said, what I'll do, let me turn off the webcam for the moment. And let's talk about 3 barriers for traders. And we've all experienced what I'm going to show you, so I think we can all relate. Day trading, first of all, it's not that easy, folks, and there's some barriers to day trading. Let's take a look. It's making a lot of headlines, especially this year, especially in the last few weeks with GameStop, so I thought I'd throw this in there for kicks. Day trading's a difficult thing unless you bought GameStop here and sold here, right? It always looks easy in hindsight, but it's difficult. Here's a gentleman, he had a firm, he trained day traders, and over a 5-year period of time, he figured that 3.5% to 4.5% people were actually successful producing consistent profits over a period of several years. And then here's a study in the Journal of Financial Markets. It says here less than 1% of the day trader population is able to predictably and reliably earn positive abnormal returns net of fees. So the odds are against all of us if we want to be successful day traders. Let's just face the facts, folks. It's not that easy. But having said that, it has the appearance of being easy, at least this last year, or at least easier when you have a market that's really moving pretty much in one direction, which has been, as you know, up. But really, day trading often requires, obviously, screen watching. Who wants to babysit trades all day staring at your screen? So we don't really want to be like this guy here, although, you know, sometimes people think it's necessary, but it's not. And here's the other barrier, number 2, precision. So let's think about it. If you're going to be trading, whether it's no matter the instrument, a lot of things have to go right. In fact, almost everything has to go right. If you're going to, you know, buy a share of a security, whatever it is, you need to be perfect with picking the correct market, pick the correct direction, apply the correct strategy, Then you have to have the correct entry timing, which is essentially price, and then exit. How do you manage the risk and reward? So all those things have to line up. And it turns out that monkeys might even be better traders than all of us. I love some of these studies. Hypothetical back testing with monkeys throwing darts, and they outperform the index by an average of 1.7% per year. So there's your best day trader, folks, right there. Now here's the third barrier, emotions. Basically us. This guy here is perplexed. Remember him, Get Smart. And so you don't want to end up like this with your emotions getting the better of you. Still thinking the market was wrong as you're made it all the way and taking your trade into the grave. Markets are always correct and we aren't. Ed Sequoia says it can be expensive trying to convince the markets that you are correct. I think we can all relate to that. That's from Market Wizards. He's featured in that book along with some of the turtle traders and I think Paul Tudor Jones, Jim Rogers, and there's 2 or 3 subsequent books to Market Wizards, which you might enjoy getting into the head of these, the heads of these bigger traders. So we have all these thoughts running through our head every time we place a trade. Let's admit it, folks. You get hopeful, you get fearful, you have anxiety. Sometimes you're bored, you want to just do something, so on and so forth. So really, we have bad wiring. That's the problem with trading. We have a built-in bias to make poor investment decisions. We chase past performance, we sell the lows, and we buy the highs. And it's really what we do too often, even the best of us. And that's the reason why is because our brain kills our our investment returns, according to Real Investment Advice. And I think that's kind of a fair assessment. And Motley Fool says there are 3 common biases when making investment decisions. In fact, we become, the worst financial enemy is us. That's kind of one way to phrase it right here. But we can all relate to this, and even if we don't always recognize it at the time, confirmation, anchoring, and recency bias whenever we're placing a trade or even making a decision on any investment. We end up sometimes like this gentleman here with blinders on. He says, I'm doing great. My stocks are great. What else do I possibly need to know? And he's just completely oblivious to the world around him. So there's definitely a bias there. You could call that recency bias or confirmation bias. It all depends. But let's jump into part 3 here before we jump into the demo. We're going to show you a live demo, by the way, of our trading technology. And remember, algo trading, computers, machines, whatever you want to call them, they are completely non-emotional, and it turns out they're dominating the marketplace. It's something like 80% of the marketplace is driven by machines. And here's an article in Bloomberg talking about robots outwitting humans on their investment picks, so that's no surprise. But that's really revolutionary trading, right? That's just the sign of the times, and it's really not going away. So here's what trading used to look like, folks. This is just a grainy old video I have from years back on the trading floor. Okay, and now here is what it looks like now. This is how it looks, all of that seemingly chaotic mayhem on the trading floor, which actually was very efficient and very effective, even though it didn't always look like it. But this is what is replacing everything. No emotions, automation, built-in controls. So how can you use this automation and this technology to trade options and sort of compete in this new landscape? So that's what we're going to talk about here in part 4, automating your options trading. And then we're going to look at a really unique strategy, a weird strategy, let's say, for automated trading, something that you're going to want to definitely stick around for. So we're going to look for strategies in up, down, and even non-directional market conditions. We'll look at trading stock index futures markets in particular, and we're going to show you what the advantages are for that space. Then we're going to look at our secret strategy we talked about. But first, a little background here, kind of set up the trading we're doing. If you're familiar with selling options, that's okay. It's going to go quickly, and there's also a new twist, so stick around. If you're not familiar, it's something we've made very, very simple and approachable. So stick with us here, folks. Insurance companies, how do they make money? Obviously, you pay premiums, and they insure you against risk, and they basically sell and manage time. That's all they're doing. They hedge themselves, of course. They're consistent and patient in their business model, and they just look at probabilities. They're simply looking at math and what are the long-term odds. So they look at statistics, actuarials, expected returns. They simply crunch numbers and they have a process, and then they tell you what the premium is based on, all the factors and inputs on how old you are and, what your driving record is or whatever, health record, whatever it might be. And really they're looking at statistics, something we might know as the law of large numbers. We don't think about it, but flip a coin a million times, you're going to get 50% heads and 50% tails. You flip that coin 5 times, you might get all heads or all tails. So we're all familiar with how that works. And that's sort of the whole concept behind even being the house or like a casino or an insurance company, higher probability outcomes. So example, you spin that roulette wheel on that 0 38 times, $100 each time, you're going to lose $200 according to the law of averages, and that's $5.26 on average, but that becomes the house edge. So now you know why casinos are so big and so successful. They only play games in which they have a big edge, and this is an example. I think roulette's one of the biggest. Blackjack might be one of the smallest, actually, depending on there's one card or 6 cards or whatever, decks, I'm sorry. So, and also what the rules are. So anyway, but they do this, they'll have you sit there and play forever because ultimately they have the edge. And higher probability outcomes, maybe looking at a baseball analogy, what's the higher probability, a grand slam or a base hit? We're clearly the base hit, not a home run. So what about high probability option strategies? How do you collect those premiums and those base hits? Well, you would go short or sell options, collect the premium that the buyer is paying you. You need to be consistent and patient, just like an insurance company, but you need to manage your risk because you know that you're going to have losers for sure. And there's no matter what anyone says, you're going to have losers, folks. Manage reward. Don't get greedy. That's a big key right there. And I'm going to show you how we handle that. But you need the proper tools to make this happen because it can be complicated and overwhelming. There's so many variables when trading any instrument, especially options. So many base hits, that's what we're going to look for. We're going to look at some short option strategies, premium collection, non-directional, bullish or bearish, higher probability outcomes with predetermined risk. Let's look at a couple credit spreads here. These are insured positions, predetermined risk and reward, and they can be non-directional in nature. So advantages of credit spreads on a stock index, not an individual security. So there's a large margin of error when you're trading with a stock index compared to an individual security. And we're going to run through some of those examples, and don't worry about this chart yet. We're going to get to that in just 2 or 3 minutes. But first, we're going to look at 2 Greeks. You can get into second order Greeks and derivatives upon derivatives, and we don't need to do any of that, not for our purposes. If you know what they are, great, this goes quickly, and if you don't, we've made it really simple. The first thing we look at is delta. Delta is the approximate probability of an option expiring in the money. So if a delta is 0.25, that means there's 25% chance expiring in the money, but conversely, 75% chance of expiring worthless. And remember, delta is always moving up and down with price and time. It's not static, and it is not the probability of a winning trade. So sometimes people assume that that's the probability that the trade is going to make money for them. That's not correct. Now, theta, time decay. Let's look at time decay. Every option has a limited lifespan. So theta refers to sensitivity to time. It's a negative number. It equals 1 day of time decay. For example, if an option's 10 points and theta is negative 0.05, the next day the premium is 9.95. The next day it drops to 9.90. So basically the value decay or the theta decay has an impact on that premium. So this is what it looks like on a graph. You see as you approach time 0, the percent of the premium remaining decreases more and more rapidly. Now here's a graph here of a call spread. In this example, we're selling a 35.30 call. You receive 4.5 points, and then you buy a 35.50 call simultaneously, and you pay 2.25. So the net result, 2.25 points, $112.50 minus any commissions and fees. So simply put, you sell an out of the money call spread, collect that money. That's what it looks like on a graph. You're selling an out-of-the-money put spread, same type of thing. In this case, you sell the 29.90 put, you're collecting 3 points, and then you buy the 29.70 put, you pay out $1 point or 1 point for that, and your net result is collecting $100. So that's what it looks like on a graph. Remember, these are not naked options. Everything is insured or hedged. Your maximum risk is capped in advance. So these are what is known as covered spreads. So no naked trading. And there's a big advantage, by the way, if you're doing covered spreads. In fact, we would never ever suggest trading naked options. If you're doing it or some people are telling you to do it, it's going to probably work for a while until it doesn't in a big way. So I've never seen that end well after 30 years. You only sell covered options. Not only is there unlimited risk with naked options, but you're going to have margin calls, and that's going to really jerk your trading around, force you out of positions and so on, and make you liquidate and take risk off of other positions, and the market's going to be trading you. So anyway, enough of that. Iron condors, I'm sure some of you are familiar with that, but let's look at an example here and then how we do it with our automation. So it's a simultaneous put spread and call spread. So what am I talking about? You sell an out-of-the-money call spread, simultaneously sell an out-of-the-money put spread, collect the premium on the calls and the puts. Just that simple, folks. So here's that weird strategy we talked about. You're probably curious, so let's get into it. It's a bit of a secret because it's really our design. It's called a dragonfly and has 6 legs or 6 different strike prices. And here we go. Let's take a look. It's a variation on the iron condor. And let's walk you through this. So you can see the, in this case, the E-mini S&P 500 kind of moving along here. You see calls above the market and puts below the market. So here's the structure of the trade. Each condor, or I'm sorry, each dragonfly sells in increments of 4. So you're selling 4, in this case, 37.80 calls. You buy 3 further out of the money calls, and then you buy 1 closer to the money call. And notice this one here is 50 points closer to the money. So quite a bit closer to the money compared to the 4 that you've sold. And let's look at the puts here, same structure, selling the 4 puts. You buy 3 further out, and you buy 1 closer to the money. So for every put you've sold, you've bought 1, and same thing with the call. So these are still covered on both sides. And notice too, 50 points closer to the money, 28.70 put, 50 points closer to the money. And the reason we build this trade this way is, I'll show you in the demo, we'll look through some simulations and so forth, but this call here that you own is going to have essentially be less impacted by theta decay, and it's going to gain in value more quickly if the market's moving up closer to these this upper boundary here where you're short those calls. So it's going to have a completely different risk and reward parameter, and at times in particular. We're going to show you that. But here's the question: how would you know which dragonfly to build or condor? How do you know where to begin, which one to buy or sell? In this case, selling a condor, but of course you can buy condors too, and I'll show you that. Which strategy to apply? What's the price? What's your timing? How do you manage the risk and the profit? So a lot of questions there. So that's what we've got the answer for you. It's called Theta Trader. Actually, some of our floor traders down there. Pre-built option spreads. That's what we're talking about. Our proprietary algo will create what we call theta trades, and you can have advanced strategy automation as well to handle those trades for you, bull, bear, and flat market conditions. And then automated risk and profit control, something called the RTI, or the risk thermal indicator. So Theta Trader is simple and effective trade selection and management, taking something complex like option spreads and making it simple. So it's time to jump into the demo. So just bear with me as I jump over to a different machine here. All right, folks, here we are. You're looking at the dashboard for Theta Trader. And let me walk you through here what we're looking at, just so you can see what the home page or the dashboard looks like. You'll notice this section here are theta trades. Below it would be your open short positions, any open long positions below it here. And here's your account info. Theta Trader is pulling directly out of your AltaVest trading account, and then current price quotes on the markets that we're primarily trading. So why don't we start here at the very top and let's break it down for Theta trades. And remember, this is what the algo generates every day on your behalf. So this is what the formula suggests each day. You can see there are bullish strategies, bearish, and neutral strategies, all pre-populated. And we talked about stock indexes. We're looking at the E-mini S&P 500, NASDAQ 100, and Russell 2000. Those are the primary markets. And we'll show you why in just a moment. But really, let's focus on the ES. That's where the majority of the volume is. And we looked at the Condor and the Dragonfly. So let's break that down here. Let's look at an Iron Condor. Now there are trades available anywhere from 16 days till expiration out to 58 days till expiration. So these are all pre-built. They're already built and ready to trade for you. The strikes are chosen, the expirations, and the valuation. We'll look at the April week 3 expiration. Let's click on that. In fact, before I do, let me just explain this here. This acronym here, potential profit at expiration, and then your targeted annualized return at expiration. Now keep in mind, it's not realistic to ever expect to generate a return based on the targeted annualized return at expiration. It's only there to really compare one trade to another, because it just assumes that if you were to win on this trade at expiration, then the very next day you'd place the same trade and just continue to win on that same trade essentially throughout the remainder of the year, and that's not realistic. And the profit potential at expiration too is there also to compare one trade to another, because, and I'll show you why we do this, but we never hold trades till expiration. So it's also something to keep in mind. Just use these metrics here to compare one trade to another. All right. Now, the first thing I like to do, and I'll explain all this in a moment, is I look at the chart. So here's what it looks like, the overhead macro helicopter view. This is what the trade looks like here. We're trading now. You're selling this out of the money call spread and put spread. And you'll notice here, let's go through this bit by bit. Days till expiration, expiration date. Settlement value on the spread is 2.5. The net premium, put risk, call risk, commission, available capital in the demo account. Now here's the thing, cash required, and this is your profit potential maximum. So it's almost $900 to make about $100. And here's your targeted return on cash, just over 11.6%, and targeted annualized return. But the question we often get is, why would you put up $900 to make $100? Well, let's look at the strike prices. Remember, these are pre-selected by the algorithm. The put option, you're selling the 3360 put, has a delta of 9.97. So remember, we talked about delta. So that means there's over a 90% probability that this option is going to expire out of the money. And the call option that we're selling, delta is 6.8%. And you're looking at, once again, a 93% probability that this call option is going to expire out of the money. So that's the higher probability outcomes that we're looking for when we're working with Theta Trader. And it's pre-populated to sell because you're selling a condor. Quantity always defaults to 1. I'll just put in, let's say, 4. You'll notice the margin requirement and potential profit, everything changes with quantity. And then we can leave the gross value at 2.5, or you could change it depending on whatever number you had in mind, but we'll go ahead and leave it alone here for this demo and go ahead and place the order. So you see here it's placed and it just assumed you're filled in the demo account. All right, now here is a really nice little feature. We're going to go back and I'm going to show you. Instead of looking at a Dragonfly, I want to show you the trade simulator. So we can go backwards in time with our simulator and look at any period of time and apply any trade, whether it's a condor or a Dragonfly. And I've loaded some up here just for the sake of saving some time. Okay, and this is a great feature. You'll see here, this is an iron condor for the January end of month expiration. So the first day on the trade was December 1st of last year. And we use these buttons here to control. You can go to the end, or you can go one step at a time, meaning one day at a time, or backwards a day at a time, or just use the play button and watch the trade play. But you can see here, as you watch the trade play, it had 60 days till expiration when we first placed the trade, losing a little bit of money right away, and that's normal when you're selling premium because theta decay hasn't worked yet. And now you'll see the green, the RTI is green, and that means do nothing. The signal is to do nothing, allow the trade to mature. Nothing to do. It's turning profitable. All systems go, essentially. And we'll go ahead and see what happens here. Okay, so you can just see the market's moving sideways to slightly higher, but really within range of not really getting us into trouble. And you can see the trade is becoming profitable. And it turns blue. And what does that mean? Profits. That means take profits. The algorithm says it's now time to take profits when it turns blue. So this is your profit-taking signal here with 15 days remaining on January 15. Now here's the key. So I'll re-emphasize this and I'll show you more about it in just a minute. Theta Trader automates this. You do not need to screen watch or do anything. Once it turns blue, Theta Trader will automatically close out that position for you. And we can do that with profit targets or risk. And I'll show you that in just a moment. But now remember, that's an iron condor trade. Worked out just fine. Placed on December 1st. And that's for the January end of month. Now let's look at the dragonfly. So the same day, instead of a condor, what if you placed a dragonfly? Let's find out. And look what happens here. On December 28, it turns blue. It issues a profit-taking signal. So the dragonfly matured much more quickly than the condor. Remember, we had to stay in that trade till January 15 before there was a profit-taking signal according to the algo. But with the dragonfly, we were out, what was that, 17, 18 days earlier than the condor. So you can take your money off the table and put it into another trade in the case of the dragonfly versus the condor. And that happens a lot. And we talked about the structure of the dragonfly. Remember, this call option that you bought, you own it. So it's also closer to the money compared to the ones that you sold. And that means it's not going to decay as rapidly in value. And at the same time, it'll increase more rapidly if prices start moving higher, closer to that upper boundary. So the dynamics of this trade and this structure can make a big difference compared to a condor. We like it a lot. We use it a lot. It's kind of our primary bread and butter. You do give up a little bit of potential profit, but we like the idea that you can sometimes get out a lot earlier. And also we like the idea that sometimes a condor may have a loss and a dragonfly may not. So let's look at another example. Here's another condor, January 2 of last year. Okay, it turns yellow. Elevated risk, but do nothing. You don't have to do anything. Just letting you know, the algo says the risk is becoming a little bit cautionary here. Still green, do nothing. Oh, it turns orange. That means a more elevated risk or threat level, and then it turns red. Too much risk, get out. Now you can automate this as well. When it turns red, according to the algo, you close out that position and you are on to the next trade. Take your loss and move on. So that would be the condor. Now, on that same day, January 2, instead of a condor, maybe you placed a dragonfly. Let's watch what happens. Turns yellow, a little bit of cautionary risk there. And look at that, it turns blue. It gave you an opportunity on that day to take profits off the table, and as opposed to the condor, it never actually turned profitable, but the dragonfly did. So that's a really unique trade structure. Just running through a couple simulations, we'll do one more. Here's a trade from a while back on a condor. And look at that, it turns blue with 37 days remaining. So that trade worked out. And let's compare that to a dragonfly. So this dragonfly turned blue with 41 days till expiration. So you can see that a lot of times dragonfly will mature more quickly than the condor. And the whole idea is to take your risk off the table and set a new position. So that's why we love these dragonflies. And let me show you how to handle the automation. You just go to the settings link here. And all you do is account settings. You click this box to activate risk manager and activate profit directive, and then save those settings. And then from there, Theta Trader does the rest for you. And then you'll also note, I'll point out a couple other things. In fact, let me jump over here first. You'll also note on the home page, you can see the open short positions and long positions, but also you can look at them all on one page. Let's jump over to the open positions page. So you see here there are 8 short positions on the page currently, or basically in the demo account, and anywhere from 42 to 58 days till expiration. RTI is green on all of these, and if you wanted a little more depth on any one of them, you just simply click on it. We can drill down, get a little more granular. And you can see here when you place the trade on February 11, so far it's all green, nothing to do. This is not much to see on the graph yet because only a few days of activity there. But that's how easy it is to see your open positions at a glance. And then this is how you look at closed positions. And you can filter for any market and any date, but we're just going to look at all of them here. You'll see a total of 20 on the page, 19 winners, 1 loser, short positions, 15, long positions, 4, and your total P&L on all these closed positions. It's just a demo account, folks. I use it for webinars like this, and as you saw, I just pick any theta trade and I just place the trade, and that's what you see in the demo account. So at the moment, these trades are doing very, very well. And once again, you could do the same thing if you wanted to look at the history of any trade. You just click on it and drill down. And this was just selling a put spread in this case. Then it took profits here with 14 days remaining. The algorithm said that's enough, time to get out. All right, so that is how we do open positions, closed positions. You saw on the Theta Trades page how to look at a dragonfly, how to look at a condor, how to place those trades. And then let me point out a couple other things, and I want to show you the best feature of all. We have research we're doing every day, of course, proprietary to Altivest. It's our TradeScope newsletter. We're looking at technicals and fundamentals, of course, and looking at market outlooks and trying to position our trades accordingly with the help of the proprietary research. And then we also do a daily narrative called the summary. And this here provides, we had week 1 dragonflies filled this week, yesterday actually, and here's what's happening in Asia and Europe and the US. And then of course, looking ahead and then economic calendar. So a lot of feedback from our proprietary research as well. And then we have a help file, which is actually not too uncommon, but this is where you would go, for example, if you want to know what all the color coding is. and what the breakdown is on the color coding, and there's descriptions here on the strategies. So it's all broken down for you here, as well as within the help, right below the help file, there are videos on tutorials for Theta Trader and education. So options, education, videos, all included within the Theta Trader platform. All right, now I think I want to point out one other thing here, and then I'm going to jump to the best feature of all. Also want to point out that we've looked at neutral strategies or non-directional like condors and dragonflies. But remember, there are always bearish strategies and bullish strategies available. Here's one called a bull hedge. I'll give you an example. This is what it looks like on a chart. You buy an out-of-the-money call spread, and to pay for it, you sell an out-of-the-money put spread to finance it. So it's really a synthetic long position in a way, so we just like to call it a bull hedge. But there are strategies like that. We did some butterfly calls the other week. That was an interesting trade. You can even do half of a dragonfly. And what do I mean by that? Well, you don't have to do both calls and puts. Maybe you just do the put side of a dragonfly. So if you're looking for the market to basically go sideways to higher, that's what you would do. And of course, you could do the same thing, with the dragonfly call. So just wanted to point that out. We're not just selling premium all the time, 100% of the time. There are times, by the way, when we might simply just buy some put spreads or call spreads or butterfly spreads or what have you. So just want to let you know it's all available, but primarily Theta Trader was designed to make collecting premium easier because that can be a real mess. All right, with that said, let me show you the best feature of all. All right, a little bit of humor there. So with that said, we can make it easier. This is what clients really can't live without. Trade alerts. And we can do this in just 1 minute. And that's not hyperbole. One-touch responsive trade alerts. And what am I talking about? You receive the alert on your device, and all you have to do is touch accept or reject. That's it. Our technology handles the rest. For example, the alerts are live and they're integrated with your account. So the technology is all integrated with your account. If you like it, you touch accept and the order is then placed. Why don't we look at an example here? You get a text, you touch the link. You get a graph, you see an explanation of the chart. In this case, it's a condor, the trade. Notice your account, the net premium collected, cash required, and notice this, the quantity is already correct for your account. Everything is pre-sized for your account, and the value is already determined for you. And you'll notice the days till expiration, targeted annualized return. And then if you like it, you just touch accept, and that's all you have to do. Let's look at that one more time. I won't interrupt this time. Okay, folks. So with that said, quite honestly, people can't live without those alerts anymore now that they're kind of become accustomed to them. So those alerts will go out during trading hours, and you can be doing anything anywhere. If you have your phone, your pad, whatever it is, you receive that alert and you just touch the screen That's all you need to do. Our technology handles everything else. So here's the offer. Become a member and ThetaTrader user. Our ThetaTrader membership gives you some enormous benefits. Here's what you get. Of course, ThetaTrade, the software itself, you have the Theta Trades. Remember, the proprietary algo creates the option spreads for you. So you don't have to labor over what trades to choose and look at option chain and try to figure out the strikes and values and expirations. The algorithm does it for you. Simple and effective trade selection. Remember, the risk thermal indicator will automatically close out those trades when they turn red or blue. So that's what we call autopilot and non-emotional trading. We have that trade simulator. You saw us use the simulator. And of course, you don't have to play the chart day by day. You can just go click the end arrow and just see it instantly. So you can go backwards in time and back test the various theta trades. It's a unique feature as well. So you have Theta Trades, the RTI, the simulator, that software valued at over $3,500. And then, of course, the one-touch trade alerts. Remember, these are integrated with your account. You don't have to receive an alert and log into some other platform and then try to copy the alert that you received into your platform and hope that you get it right. Because you know what? A lot of people don't, and I hear about it. People call me, they say, I like the alerts. In fact, I just made a mistake on an alert. I did a buy versus a sell. I mean, that's a huge buy-sell error. That's enormous. That's a big problem. Or they chose the wrong expiration, or they did, you know, unbalanced, or whatever it might be. So you don't have to worry about that with these alerts. Each trade is designed and tailored for your account in terms of the size of the quantity of the trade, as well as the strike price of the trade. And remember, these are live, integrated with your account, and all you do is touch accept. And then once the trade is filled, you saw how the RTI can automatically manage the trade for you. So that alert software there, valued at over $4,400. So once again, ThetaTrader software, the alerts valued over $8,000. But here's the real key. You get to tie it all together with a private coach. We're a completely different business model. We're not just online-only chatbots. We're real people. You get to work with a private coach with your 1-hour screen sharing sessions. You can talk about your trade selections, the RTI, even, you know, you can even adjust strike prices if you want. Some people do, but kind of defeats the algo purpose, I think. Trade alerts and looking at advanced strategies as well beyond just what might be in the theta trade. So there's a lot we can do with that private coaching. You have a co-pilot, you know, develop a relationship with a person with decades of experience, licensed, regulated, discuss history, review history, $7,500 value. I think that's way undervalued. I know people are selling education for $25,000, and what we're telling you, that's fine. You can be educated, but you don't need to have that to do this, because we work with you and we'll provide you what you need to trade with ThetaTrader. So remember, ThetaTrader software, the alerts, the private coach, valued over $15,500. And in fact, there's more. A little corny, but I thought I'd throw that in there. Remember, the proprietary research, valued almost $3,000 for TradeScope and our daily commentary. Then, of course, the video tutorials, that's just part of the ThetaTrader platform. So to summarize, an $18,504 value with a ThetaTrader membership, ThetaTrader software, and the Theta Trades, the trade alerts, the private coach, and the research. So here's your special offer. It's a live presentation. It's going to be highly discounted because it is live. It's not just our typical, what they call evergreen retail rate that's on the website. $1,497 is the cost of the ThetaTrader membership, but we're going to do a lot better than that. 60% discount before Sunday night. Try to encourage you to take a look at it. $597, one-time payment. That's your lifetime membership. So just to be clear, we get the question all the time. It's only one time, so it's not quarterly, monthly, yearly, one-time payment. And that's $597. And there's the link, cf.altavest.com/TT. And that's my direct number. And of course, if you want to call now, that's fine. Have any comments or questions, just it'll go to voicemail or it might bounce to somewhere else, but that's fine. But really, you can go right to the link. And here's no excuses, folks. We made it so easy. If you sign up and a month from now you decide it's not for you, it's not a good fit, we'll refund that membership fee. So 30-day money-back guarantee on the membership fee. We're not going to hold you hostage. It's not how we operate. We've been doing this since 1997. And here's a few FAQs, and I'll see about getting to some other questions and so forth as well. But there are a few FAQs that people always have. So note, we do not trade stock options. Remember, we're only doing options on E-mini stock index futures with ThetaTrader. Okay. And what about tax efficiency? You can lower your tax rate by over 10%. Well, futures and options are tax efficient. 1256 contracts, meaning that's the IRS code. So they receive basically special treatment. So the combined blended tax rate when you're trading futures and options is 10% lower than if you're trading stocks. It's a big deal, folks. Here's an example. Trading individual stocks, 20% return on 100 grand, you get a 12.6% IRR. Same result with futures, 20% return on 100 grand, 14.64% IRR. Tax savings of over $2,000 because you're trading in a tax efficient environment. That adds up to some serious dollars if you're trading in tax efficient with instruments that are tax efficient. And there's no more itemizing. With futures and options, you simply receive your 1099, has your P&L, and that's it. There's no wash sales and itemizing, all that nonsense. IRAs, yes, ask us for deals, how to qualify. Self-directed IRA accounts, absolutely. Forbes says they can diversify a portfolio by adding investments with a low correlation to stocks and bonds, help control volatility and limit downside risk in portfolios. So you can definitely do self-directed IRAs, but there are some different requirements, so do ask us about those details. Here's another question. Why stock market indexes versus individual stocks? Well, let's look at a couple reasons why. They're less volatile. So an index might move 2 or 3% in a day. That's a big move. Individual stocks, as you know, can move a lot, 10, 20, 50% in a day. And how about the secret strategy, that dragonfly? You cannot use a dragonfly trading securities. It just doesn't work. And I'll show you why in just a second. And also, we like to just focus on 1 or 2 markets, not thousands of stocks and funds and ETFs. It's too difficult to track, in our opinion. So that's why we specialize in this. So here's an example why we trade the indexes. How about the AMC, 1,000% rally in a week? You're not going to find that in an index. It's great if you were long, but if you weren't, that's the kind of thing that can wipe you out. And here, non-correlation. So here you have GameStop, skyrocketing, and meanwhile the broader stock market choked on that. So really the key I think we're getting at there is simply that, if you're trading an index, then, a lot of times it can be non-correlated to what's happening with individual shares of stock. So we like that non-correlation. Now here is the reason why we trade the E-mini S&P or the ES. Liquid, efficient, and cost-effective. I think you'll probably learn something here for sure. The ES is 2.5 times larger than all the ETFs around the world. So that was a shock to me actually when I figured that out a while back. So it outtrades all the ETFs around the world. That's from, I think that data is from last year. I don't know if they have the updated data, but I would imagine it's very, very similar. So this is the market you want to be in, folks, the ES, the largest dollar size. So compared to the SPY, everyone talks about the SPY, the ES average daily dollar volume is almost 10 times greater compared to the SPY. So the ES is the boss. The ES is the boss, folks. 5 other reasons to trade: deep liquidity, average daily volume 630,000, 2019. We'll have those numbers, I think, for 2020 soon. So there's just so much depth and liquidity, largest market share. We talk about densely packed strikes and 100 annual expirations. ensure granularity and coverage that you would need. So that's one of the reasons why, for example, you won't be able to do a dragonfly on a security. The strike prices don't exist. The granularity is not there. Now, maybe if you're looking at, something like Apple, you can get closer to the money strikes above and below the market, and that should be no problem. But even so, if you want to go really, really far out of the money, it's probably going to be a bit more difficult, just the way it is. So we talk about granularity and laddering strikes. Here's an example. Here's placing a condor here with puts and calls. Then some time goes by and you place another one with different strikes on your puts and calls. And the same thing here with the blue line, another set of strikes on the puts and calls. So you want to keep your strikes laddered. You don't want concentration risk. And that's something you can work with. We can help you with as well with your advisor. So it's easy to track just one or two markets, and margin is efficient, and there's a clear cost structure. And also the superior execution. The ES options offer a savings of $4 to $15 per contract. So tight bid offer spreads and no hidden costs. So the ES options are not securities. They trade at the CME Group, the largest futures exchange in the world, on the Globex exchange. It's the electronic marketplace. So every order is treated equally, large or small. Now that's a big deal these days, folks. I'm going to kind of beat up on some of what's happening here in just a second, but I won't beat it to death, and we'll move on. But there's no payment for order flow nonsense like there is in the stock market. In fact, Congress is hearing from, Robinhood and so on and so forth about all that. I mean, these guys are, they're basically, I don't know how it's legal what they're doing, but it is. And here's a Robinhood paid $65 million fine. They said here, you're saving a penny to lose a nickel trading with someone like Robinhood. Says if you're not paying for something, you're going to pay for it in a way you can't see it. I think that's important, folks. And I'm going to beat up on Robinhood and the others that claim to offer free trading. That's my grievance here. I don't care. I mean, I'll trade stocks. I mean, there's nothing wrong with that, but it's not free. So the SEC finally caught up to them. And they charged Robinhood with misleading customers about how they make money. So here, Robinhood provides inferior trade prices, costing customers $34 million. And I would imagine the number's quite a bit larger than that. And here's an article today exposing the Robinhood scam. So basically, what do? It's called payment for order flow. Quite simply, you place your orders with Robinhood or any other brokerage that says they're offering you free trades and stock trading, I'm talking about, and they don't fill the order. A third-party market maker fills the order, and that market maker pays Robinhood for the right or that order flow. And the reason they do that is because they can fill those orders at less advantageous prices and basically pocket the difference for themselves. So everyone's kind of exploiting the retail order flow and the retail customer is really so. Nothing of value is truly ever free. I think we'll just kind of leave it at that. And that leads to the question, what are the commission rates? Well, our theta trader rates are 5.25 all in, and that's round turn. So they're competitive in the futures and option space. Here's a brokerage here copied there at 225. So at first glance, you think that's cheaper. It's not. That's per side. And then they add more fees on top, and it's even higher than what we charge. So yeah, some people are less, some people are more, but our rates are competitive. And quite frankly, we're a completely different level of service. We're not even really trying to compete with them on that online only type of universe. What's the performance of Theta Trader? Well, keep in mind, everyone makes their own trading decisions. Every client is different. Everyone has different results. But I will remind everyone that all the numbers in Theta Trader are net of all trading cost. So all the percentages and dollar figures you see are net. What size account should I trade with? We recommend $50,000 to $100,000 if you want to have multiple dragonflies and condors trading. If you want a free membership, absolutely, no trouble there. $100,000 or more account size, and we gladly refund the membership fee to you. And then I've got just a couple more minutes here. You want alternatives in your portfolio. We don't think stocks will rally forever. So you might want to look at some alternatives. That's the whole point. I think we're running out of time. So you've got kind of the running of the bulls there, chasing the market, FOMO, right? We're not going to get into all this here. I think we're running short on time. And let's see here. Oops. Just keep it coming. That's kind of a funny one. All right, so there we go. We're going to wrap it up, and I'll leave it right here. And let me see here if I had any other comments. Okay, I see the link, and I'm just looking through the questions here. Yeah, someone asked about IRAs. Yes, only futures options, iron condors, so on and so forth. And Anna, how are we on time?
Eric, this is the last spot of the day. You can go a bit longer if you wish.
Okay, I'll just try to get through some of these questions. Thanks for all the questions, everyone. Let me just jump through here. Yeah, that's a lifetime membership, and you pay one time. And we like the Dragonfly, actually. In most situations, we like the Dragonfly, but that's not to say we don't ever do condors. We do a bit of condors as well, but we do like the way the Dragonfly will hold up to certain movement in the marketplace, and the condor doesn't hold up as well. Yeah, this is only for futures, and yes, once again, IRAs. And someone asked about depending on where you live. Yeah, we have clients asking about trading over from if you're living in the EU or a lot of people in Canada or other countries, and it just depends. There's some regulations that don't allow customers from certain accounts for some reason, or from certain countries for some reason. Why we can't have a client from Canada is beyond me, but that's just the way it is. But if you do have a legal U.S. residence, an address, then you can have an account. And someone asked, why is there a loss potential when you're doing a credit spread? Well, quite simply, the trade can move against you. No matter what trade you place, it always has risk. So if the market moved in the case of a condor, and you're selling, let's say, the 3,900 calls, and you buy the 4,000 calls on the S&P, if the market ran up too quickly, by too much in magnitude, then your risk on that, of course, is the difference between your short and your long strike, which is 100 points, minus the premium you collect. And then people are asking about performance. Yeah, everyone's different. It is self-directed, and the membership is let's see, what's someone asking here about the membership? Yeah, the membership includes access to all the software and all of our services. But when you're trading, of course, every time you place a trade, there's a commission. All right. So yeah, do feel free to reach out and visit our link, or you can send me an email. You can go to info@altivest.com or eric@altivest.com if that's better for you, or cf.altivest.com/TT is the link. And with that said, I think we'll wrap it up. Oh, I see another question. Account size, we do suggest 50 to 100,000, but it's not written in stone, of course. I'd say the bare minimum would be closer to 25,000. Otherwise, you're limited to how many dragonflies you could do. And we are the brokerage firm. We are AltaVest. So we are the brokerage firm. This is technology that we developed. It's our own IP. And so if you are wanting to use ThetaTrader, we'd love to have you on board. You'd simply open your trading account with AltaVest. Any other questions, ladies and gentlemen? Anyone want to see anything else? I guess I've got some more time here. Someone's talking about managing losses, I see. Someone says, thank you. Someone says brokering. Well, managing losses is really what the RTI does. So the risk thermal indicator will automatically close out your position when the algorithm decides that there's too much risk. So when the RTI turns red, that position will be closed out automatically for you if you choose to do that. And the 597 membership, yes, that expires Sunday evening, and then it would revert back to the $14.97 retail rate. That's correct. And then remember too, if you're not 100% sure, or maybe you're 90% sure, you can certainly sign up. And like I said, if it doesn't work out for you, you change your mind. It's not a problem to rebate you. 30-day guarantee. So we're not going to hold you hostage if it's not a good fit for you. Yeah, we can't do really, I'd say 25,000, 20 to 25,000 really is the bare minimum. Otherwise, it just doesn't work. You just don't really get a fair shake at it, so to speak, in terms of trading. In terms of our favorite spreads, we like the Dragonflies a lot. Recently we just did some butterfly calls that worked out well, and we just placed a bull hedge actually on this pullback. So we'll see how that goes. And yes, you can do qualified accounts. We have IRAs available as well, but also we have people just about every week with a trust account or LLC, or the basic individual joint. That's easy to do. A lot of times, an individual or joint account can be done in the same day, but for the other accounts that might need more documentation, those take a few extra days. And we trade with Midland Trust in terms of our IRAs, and they act as our custodian for those IRA accounts. They're very good, and they do a great job servicing those accounts. Yep, good questions, everyone. All right, very good. So feel free to reach out. You can get me at Erik, E-R-I-K, at altavest.com, or call the phone number there directly, or you can go right to that link and sign up. And yeah, the commissions are 5 1/4. That's round turn, all in. That includes all fees and everything. And everything is, of course, net of all fees. So when you have a theta trade and it's calculating the potential profit or whatever it might be, all those calculations are net of all trading cost. All right, folks. If you have any other questions, feel free to shoot them out, or otherwise I'll just go ahead and move on. We'll close out the webinar for now. All right, that's it. Thanks everyone for joining us, and I'd love to hear from you. In fact, whatever feedback you have for the presentation, I'm more than happy to hear it, good, bad, or otherwise. It kind of helps as we present what it is we do, in the future as well. Someone wants to ask more about the Dragonfly. Well, a Dragonfly is a strategy that we created. So it's really something that is available through us with our technology. And really, if you want to talk more about it, then you would just speak with us about it. I don't know of anyone or anywhere else or any other firm doing Dragonflies. All right, great. We're going to wrap it up. Thanks, everyone. Have a great day. I look forward to hearing from you. Bye-bye.